Hello and welcome everyone. My name is Kathleen Lovito and I will be your host for today's webinar reviewing the end of year market commentary with ASA Wealth Management and Trust Chief Investment Officer Art Lyons. Before we begin, just a few words about the association. ASMA stands for American Armed Forces Mutual Aid Association and is the longest standing not-for-profit association that empowers military families with affordable financial solutions. ASMA focuses exclusively on the needs of the military family and works to provide innovative, personalized, and lifestyle-appropriate financial solutions. ASMA Wealth Management and Trust's goal is to help ensure the financial security and independence of members of the armed forces community, active, retired, and honorably discharged service members and their families. They serve their clients by building an ongoing relationship with them, focusing on their individual needs and meeting those needs through our significant experience in the financial world. As always, this presentation is educational. It is for general information only, and it's not specific investment, legal, or tax advice for any of you individually. Do not rely on this presentation alone to guide your financial decisions. Since each situation is unique, the products and services that benefit you the most will not necessarily be the same as another current or former service member. For individual advice, please contact us directly. We produce this webinar series in-house with our own professional staff as a service to our members and to help them better understand the resources available to them. So, without further ado, I'm happy to turn it over to Art Lyons to begin the presentation.
Thank you so much, Kathleen, and good day, everyone. You know, when you think about 2020 and you try to describe it, and years from now, when you want to try to describe in one word what 2020 was like, what comes to mind for me is the word unprecedented. We had record moves in the market. You know, when we talk about a bear market, that's a 20% decline from the very peak of the market to 20%. That only took 16 days. And ultimately, the bear market lasted really only about 30 days. And then it started a bull market. And that's defined as taking the very bottom and then 20% advance from there. Well, that bull market only took 13 days to accomplish. These are moves that in past decades would have taken 1 or 2 years to accomplish, and here they took really about 2 weeks to accomplish. And in fact, we're still in that bull market period, which is great. But last year, more intraday swings of 5%. We would see 5 and 6 and sometimes 8% swings during the course of the day. We had more of those than ever before in history. We had record levels of volatility and volatility premiums. Those are the kind of hedging, think of it like insurance premiums that institutional investors use to hedge their portfolios. Those were at never before seen levels, especially around the election. And then also we had a massive disparity between investment styles and sectors. So for example, you had the NASDAQ, which is technology heavy. It was up 44% last year. Amazing. The S&P 500, only 16%. I hate to say only, but compared to the NASDAQ. And then you had the Dow Jones Industrial Average up 7%. So a massive amount of disparity. And then even within certain sectors like transportation, the airlines struggled so much, but then the trucking industry did very well as they were delivering everything in the world for Amazon. So an unprecedented year. It started off as an ordinary year. It began as we expected. We had great economics. We had nice GDP growth. And think about this. It was only a year ago, February, when we had the lowest unemployment rate in the history of our country. 2 months later, we had the worst labor market since 1939. So we had this virus, and that led to these policy responses. I mean, if you recall, remember it was only stay at home for 2 weeks. This was back in March. Stay at home for 2 weeks. We're going to just bend the curve enough for all the hospitals and medical staff to catch up. Well, it didn't work out that way. The policy responses grew and grew and grew, and it led to economic destruction. That's not a political comment. That's a fact. When everybody stays at home and nothing is open, not just in the United States, but all throughout the world, then the economy is going to lose. It's not going to do well. Which, interestingly enough, the policy responses, the economic contraction, all of these factors, staying at home, voting by mail, massive changes in voting, massive amounts of voter turnout, which I think many people felt that, or at least some people felt that forced a change in how people voted. And then, not one, not two, not three, but 4 vaccines in 1 year. In context, pharmaceutical companies typically take $1 billion and over a 10-year development cycle before they can get a drug out the door. And granted, a vaccine is not quite as complex as a drug, but nonetheless, to have this done in 1 year, let no one say anything bad about Big Pharma, because it was because of their innovation and also some support from the government as well that we were able to get these extraordinary things done. Now, when we talk about anything that happened that was this big, in the military we do something called an after-action review, and then depending on what comes out of that, then we develop something called lessons learned. And for last year, I think that there are 5 lessons, at least that I learned or relearned or were retaught, that I think bear discussing. And the first lesson from 2020 is that the market and economic experts are usually wrong. If I had $1 for every prediction, and I'm not talking about just the predictions that typically happen in January of every year, but I'm also talking about predictions that occurred in real time in March, in April, in May, about the economy, about the market, about various sectors. They were so far off base that if I had $1 for each one, I'd be a very wealthy person. So we do need to have a bit of caution, a bit of skepticism, and a bit of actually just doing our own homework, because these experts were way off base last year. Second lesson, I've said this for years. I will say this for as long as I remain in this industry. Human behavior influences investment returns far more than technical knowledge. There were many, many brilliant, very bright people last year that lost billions of dollars for their clients or for their own account. If all we needed to do was learn the most and learn more than anybody else, then we wouldn't have the results that we have. But instead, how people act and how people react to information primarily during periods of stress, but at any time, but especially last year when there was so much uncertainty, when there was so much stress, how one acts and reacts dramatically influence the investment returns. Thirdly, interest rates and inflation have much more impact on prices than politics or external factors. Granted, politics are important. Granted, the virus, it's important. But for a little bit, at the end of the day, when investment professionals go to determine a level of asset prices, whether it's for stocks or bonds or real estate or any number of other assets. The short-term and long-term, the risk-free interest rate, long-term interest rate, inflation expectations are far more important than whether or not the White House or Congress is Democratic or Republican. And I've shown this chart many times before. I think this also bears repeating, where historically, if you have a low inflationary environment, which we do, that is the absolute best performing stock market. At least the environment is the best performing historically. It means you're looking at price earnings ratios, 18, 19 times earnings. You're looking at a compounded rate of return in excess of 13% over a 10-year period. And frankly, we're about 4 years into that first 10-year period when I brought this up. So we have an excellent environment for equities, and we definitely have the wind at our back as far as that's concerned. Now, lesson 4, very similar to lesson 2. When markets are driven by fear or greed, that excess emotion, then you want to take the other side of the trade. And that was something that I'm pleased to say that we did for our clients in that third and fourth week of March. When the whole world was selling stock, we were buying stocks. When the whole world was selling investment grade corporate bonds, we were buying investment grade corporate bonds. And part of that is from the decades of experience that our investment team has. Part of that is just our emotional composition and the way we view the world. But it was very clear to us at that point that was the move to make. It's not always so clear, but the level of fear at that particular time was extreme, and the market continued to be fueled by fear as it moved up throughout the year. Final lesson. It's an old lesson. We've said it every year for as long as I've been here at AAFMAA Wealth Management and Trust. Ignore the noise. And the noise comes in all forms. The noise comes in the form of experts. It comes in the form of hand-wringing and worry and anxiety. It comes in the form of hey, your neighbor or your friend telling you need to get out. You need to get out of the market. You need to sell everything. Long-term investing is not a new concept. It may not even be a brilliant concept for some people, but it actually works. It actually works. And, when you look at this chart that I've shown every year for the last 5 years, there's always a reason to stay on the sidelines. There's always anxieties or wars or concerns of one type or another, whether it's economic or political or geopolitical or just in the market in general. There's always a reason to be on the sideline. But if you ignore the noise, look at that chart. That uptrend is at about a 45-degree angle, and it's really hard to go against that. So those are some of the lessons. And now looking ahead, though, for next year, not trying to be predicting, but at the same time, we do need to have some type of gauge. What are we looking for economically? What are we looking for monetarily? And then how does that play out with the way that we're positioning our portfolios? Obviously, GDP is going to rebound. The economy is going to rebound. It will be in excess of 2%. That's not a big, bold prediction. I don't know how high that GDP number is going to go. All I'm concerned about is the trend. And especially in the second half of this year, of 2021, we do believe that the rebound will be very strong. Inflation continues around 2%. I do believe, though, that during the course of the year, and probably more in that second half of the year, we could see an inflationary number that annualizes or that comes out to be closer to 3%. It's going to be interesting to see where food and energy prices play out. They had a big increase this past month. I don't know if that's going to sustain or not. But we do look for a little bit higher inflation, but not runaway inflation. Gauging the labor market, seeing how that returns is going to be an important indicator, not only of GDP, but also of inflation. The economy will be divided, will remain divided. So, some restaurants are going to do better than others. Some hotels better than others. Consumer travel, leisure travel, probably better than business travel. Airlines probably won't rebound as quickly as the trucking and shipping industry will. So within that growth of the economy and rebound of the economy, there will still be winners and losers, which also translates over to our security selection. Federal Reserve has been extremely accommodative. It's going to continue to be accommodative. In fact, they just made comments recently that until inflation sustains above the 2% level for over a year, they will not raise interest rates. So we're going to be seeing low interest rates probably through the end of 2022. That's what the Federal Reserve has told us. And I believe them. So that's going to be a very, very positive environment for at least for equity investors. Not so much if you're a bond investor, but certainly for equity investors. So our outlook is that driving equity prices will be things like earnings guidance, earnings visibility. So we had a nice upswing in equity prices last year. A lot of people didn't want to believe that. There was a big disconnect between how well the market looked, but how not well the economy looked. At some point, though, earnings have to catch up with equity prices. So that kind of guidance and visibility is going to be an important part in sustaining positive returns. A more normalized market look compared to 2020, just about anything looks more normalized. When I say more normalized, you won't see a volatility index at 70 and 80. You'll see a volatility index more in the 20s and maybe ticking up to the 30s on occasion. So a little bit more normalized there. The virus and vaccine could affect us in the short term if things aren't rolled out, if things don't progress quickly enough. But it looks like the vaccines are working. It looks like they're rolling them out as quickly as people will take them. But it seems like the market's pretty much taken that in stride. Chinese relations could be a factor. There's been some posturing in that regard, although recently some of that was backed off. I don't know about the delisting of companies like Tencent and Alibaba. We'll wait and see on that. Doesn't seem to be as much of a factor as it was a few years ago. China, just like everybody else, is trying to dig out of the economic rubble of last year. So the way we're positioned and kind of what we're looking for is that growth stocks will probably continue to outpace value stocks. I will caveat that by saying that very recently, in the very, very short term, value stocks, and when I talk about value, primarily energy and financials and some industrial companies, they have outperformed growth stocks. How long that will continue, that's anybody's guess. If it's 1 month, 6 months, or maybe for the entire 2021. But on an ongoing basis, a little bit longer out, we want to have more of a growth bent, but we have been adding some value stocks recently. U.S. is going to continue to outperform the world. Emerging markets, again, my caveat, emerging markets recently have really perked up because most emerging market companies are fueled by higher commodity prices, gold, silver, lead, tin, all the metals, oil, natural gas. And as those prices have increased, emerging market stocks have done well. At some point, that won't continue. But again, in the aggregate, we continue to favor the U.S. We continue to favor large cap over small cap. Even the small cap has had a great run since November, and we do have a weighting in that for some of our clients that have the all-world type of portfolio. But on the whole, we believe that these large cap stocks will continue to perform well. So our job is to identify what we call GARP companies, growth at a reasonable price. So it's kind of a combination of value and a combination of growth in earnings, growth in innovation, their product pipeline. So our job is to identify those names and to find the winners in an economy that is divided. Overall, though, we think that there's going to be continued follow through from last year. By that, I mean, I think we're going to have an up market this year. Single digits, double digits, I don't know. But with interest rates extremely low and continue to be low, and some type of a labor recovery and a worldwide demand recovery, we should have a positive market for 2021. Fixed income continued yields reflect a 2% GDP. We do think that there's going to be some interest rate stability, and I need to put that in the context. I mean, we have been, I think the word is probably jaded. We've been jaded for so long about interest rate levels. When we saw a 30-year Treasury selling for 1% back in March, you kind of get that in your head. Now that interest rate is now at around 2% for a 30-year Treasury, 10-year Treasuries are at about 1.1%. Those will probably go up a little bit more. I mean, that it needs to reflect a little bit higher degree of inflation, and let's understand this. A little bit of inflation right now is a very, very positive sign. It means that there is demand for goods and services. It means that people are getting back to work and they're spending their money. It means that businesses are expanding. So when we get what we call demand pull inflation, that's a very positive thing and something that the Federal Reserve wants as well. So, but in the big, broad context of interest rates, we're probably going to have relative stability. We continue to favor investment-grade corporates, although I think more and more as the year wears on, we'll see our exposure to high-yield bonds reduce. We may even start adding inflation-protected securities to guard against some of this anticipated inflation, which I think at the worst would be mild. So unfortunately, I can't tell you that we're going to get a 6% return on fixed income this year like we did last year. I think total returns, which is a combination of price appreciation or depreciation, and yields will not be at the 6% level this year. So that kind of informs our thinking on asset allocation. How much do we allocate to bonds, to stock, and to cash? And this big, broad allocation that we call strategic allocation, with our clients, when we say, okay, do you need to be in a growth portfolio or aggressive growth or balanced? When you make those broad decisions like that, that does help to avoid market timing. And I'm very, very pleased to say that precious few people, out of the 500 portfolios that we have, I think maybe only 3 or 4 of those changed at the most critical moment back in March and April. 99% of our clients had selected the proper strategic allocation for them that helped them weather the storm, knowing that they had the risk level that was appropriate for them, which is fabulous. I'm just thrilled with that because that means in the long run, our clients are going to do very, very well for themselves. However, for us, on a day-to-day basis, we can do something called tactical allocation. We have a small room to maneuver or to rebalance, and that can add value. It added value in March, added value in June, added value again in October, various times when we've rebalanced. We are looking at expected risk and return and valuations, and based on everything in the bond market and what we see in the stock market and with monetary policy, we will remain at the maximum equity allocation for 2021. No real surprise there because the Federal Reserve has told us that's pretty much where we need to be. Low inflation, low interest rates, maximum equity. So my final thoughts, nothing very brilliant. It's just to say that volatility is reduced over time. And one of the ways that we weather that volatility in the near term is by working with relationship managers, with investment professionals to determine what is the proper strategic asset allocation. As I've told anybody that I've spoken with, if you get that part of the equation correct for yourself on the front end, then in periods of stress, you won't have to make the wrong decision. And you can take a lot of the emotion that drives bad decision making, you can take a lot of that emotion out of the decision making process and experience more success. The addition to that is that the longer we have as a time horizon, 5 years, 10 years, whatever it may happen to be, 20 years, the longer we have, the more that short-term volatility is reduced and it withers away. The second thought I have is that the consensus isn't always right. Even investment professionals can overreact. Even brilliant people can overreact and make the wrong decision in the heat of the moment. And sometimes there's a lot of groupthink. And anybody that's been on a committee or a large organization, they understand what I'm talking about. So the consensus isn't always right. That's why it's important for our investment team to do our own homework, to look at things with a critical eye, to look at it not necessarily to be cynical, but to think about what if and to look at the picture from a different angle. And oftentimes that has kept us out of a lot of trouble by doing that. And then finally, ignore the noise. I feel like we end every webinar with that brilliant piece of advice. But long-term investing works, and more than that, it has always benefited investors to own a piece of the American economy as opposed to being on the sideline. We've always been rewarded for that risk. So those are kind of the final thoughts that I have, which, nothing really brilliant there, but at the same time, executing simplicity very, very well has benefited our clients greatly. And so finally, I'd like to leave you with this offer that the same offer that we've had for years, and that's a complimentary portfolio review. An objective look at your current holdings. We're analyzing risk and return, not just performance, but also what are the potential risk factors. And it's free of charge. We're happy to do it for our members. And we get our relationship managers involved, provide them with your investment statements, email them to us at wealthmanagement@afma.com. We'll provide that review. Our investment team takes a look at it. Your relationship manager will review it with you, and hopefully it will provide some value for you now that things have kind of settled down in the market and elsewhere. We've gotten a lot of uncertainty that we had in 2020. A lot of that uncertainty is behind us. So now is a great time to start taking a look at where do you want to be going forward at this point in your life. So that's all I have for today. We're always happy to take your questions and respond back to them at some future point in time. But for now, I'll turn it back over to you, Kathleen.
Thank you so much, Art. As always, a fantastic and very, very insightful presentation. So we're going to break here for now. But again, as Art said, please don't hesitate to reach out to us at any time whenever you need it. We respond every day to the military community and help them with their financial readiness, and it is our pleasure to do the same for you. So if you submitted a question during this webinar, we will respond to it within the next couple of days. So just hold on for us there. And then otherwise, you will receive an email with a recording of this presentation shortly so that you can review it at your leisure. And remember that you can always register for future webinars and review past webinars at AFMAA.com/webinars. And again, if you found this information useful, we encourage you to please share it with your friends and family. Our membership grows stronger every year because you introduce those in your military community to AFMAA. Thank you again for joining us today. We look forward to our next opportunity to assist you.